This is Alan Bush with ADMIS. In the stock index futures, we did see some new historical highs yesterday in the S&P and the Dow. However, some profit taking coming in today is futures under a little pressure. I think we'll deviate a little bit from what we normally do. Let's take a look back at some of the indicators that we had earlier this year in the stock indices. For example, in January, we had all three of the January indicators giving us bearish indications, and that would be the first day of January, the first week, and the first month of the year. All suggested that stock index futures would come under pressure, the theory being that those indicators, whatever they said, would follow through for the rest of the year. And yet stock index futures have performed extremely well this year. Also, we had the sell in May and go away indicator. That seasonal has not worked. Also, some talk that low volume on the rallies would be a sign of weakness. Of course, that has not been the case. So we continue to advance in stock indices, even though there are a variety of reasons why we should not. Question is why? The answer is interest rates are still extremely low and are unlikely to be increased anytime soon. That is the dominant influence, and that is why stock index futures will likely remain in a bull market for quite some time. Over in the currencies, seeing the euro currency lower, we had Finland's central bank saying that the disinflation that we are seeing in the eurozone could possibly turn into deflation. Of course, that would suggest more a combination is likely from the ECB, and lower rates suggests lower prices for the euro currency. Also seeing the pound advancing to another 18-month high against the euro, even though the pound is lower against the dollar. Interest rate differentials continue to favor the pound over the euro currency, and this is a trend that is likely to persist. Also, we are seeing a little strength in the Canadian dollar. We had some better economic numbers out of Canada in the form of housing starts. So from here, longer term, still looking for lower in the dollar. The dollar index did blow off to the upside last week. Lower in the yen, and also looking for higher in the pound. Credit markets under a little pressure. We have a lot of supply this week. $62 billion in offerings, with $28 billion in 3-year notes offered today. It appears that a consolidation pattern is building. We do feel that ultimately we will break out to the upside, with a new leg up for treasuries is likely. And when we do get the breakout, if we're correct in that thinking, any additional gains should be led by the 30-year bonds. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.